You've seen it hundreds of times. RSI hits 70, traders short. RSI hits 30, traders buy. And what happens next? The market keeps ripping in the same direction, and they get stopped out again. The truth is, RSI doesn't predict reversals. It exposes momentum, not magic. So in today's algorithm-driven markets, does RSI still work, or has it become completely useless? This is episode 2 of our series, What Works in Today's Markets, where we test the most popular indicators and find out which ones actually hold up. Today, we're breaking down the RSI, what it really measures, how most traders misuse it, and how professionals use it to track momentum, exhaustion, and reversals with precision. Now, before we get started, this video is for educational purposes only. I am not a financial advisor, and you should definitely trade at your own risk. Now, what does RSI actually measure? The Relative Strength Index measures the speed and strength of price moves over time. It ranges from 0 to 100. Above 70 signals strong bullish momentum. Below 30 shows strong bearish momentum. But here's what most traders miss. RSI doesn't tell you when price will reverse. It tells you how powerful that move currently is. Most traders see RSI hit 70 and instantly short, thinking it's too high. But in a strong trend, RSI can stay overbought or oversold for a long period of time. And that's when traders get crushed. RSI isn't a reversal tool, it's a momentum gauge. It's telling you how fast the market is moving, not when it's gonna stop. Now let's go into how pro traders use the RSI. 1. Momentum confirmation. If RSI is holding above 50, momentum is bullish. Below 50, bearish. Pro traders use that midline as a trend filter to stay in sync with direction instead of fighting it. 2. Divergences. When price makes a new high, but RSI is making a lower high, that's a bearish divergence, showing momentum slowing before a potential shift. The opposite, a bullish divergence, can mark exhaustion at the lows. 3. Range versus trend context. RSI behaves differently depending on market conditions. In a range, overbought and oversold zones can work beautifully for quick fades. But in strong trends, you want to follow RSI's direction, not fade it. So does RSI still work in today's market? The answer is yes, but only when you use it with context. RSI works best as confirmation, not as a trigger. Combine it with market structure, VWAP, or volume, and it becomes a powerful tool for spotting momentum shifts. Use it alone, and it'll mislead you every time. So the next time you see the RSI screaming overbought or oversold, don't panic. Read the context. When you use it alongside with other confluences, you'll stop fighting the trend and start trading with it. Now, if this video helped you see RSI differently, hit that subscribe button and stay tuned, because next we're breaking down the VWAP and how pros really use it to track true market balance. This is XViper TV. Thanks for watching and happy trading.